All right, welcome to the Eight-Figure Product CEO, practical strategies to lead, scale, and exit your physical products business. And today we have a treat. We have Kirk Michie from Candor Advisors, managing partner at Candor Advisors. And Kirk's the deal guy. So he's gonna go through multiples for product companies, what private equity is looking for these days. We have the tariff craziness, so we'll get into that. But Kirk's has a wealth of knowledge, works with many, many different businesses to get them to an exit. So he's going to be sharing that with us today. Before we get into that, head over to my website at apexceo.co and check out the exit readiness test. Okay, so if you're a CEO and you run into business and you want to kind of see, where you are, if you exited, what the strengths and weaknesses, what you need to work on, you'll see kind of on the right side of the website, a little pop-up. And it's about 10 questions, take you about 5 minutes, and you'll get an emailed a list of where you rank. And actually, soon I'll be releasing kind of a consolidated data of everybody, so you can kind of see the competition and where the other businesses lie in that. So that's over at apexceo.co exit readiness test on the home page. So Kirk, welcome to the podcast. Go ahead and intro yourself.
Thanks, Luke. It's good to be here. I love the exit readiness questionnaire. That is wish somebody had come out with that first. Or wish I'd come out with that first, but I'm gonna let you run with it. That's fantastic. So yeah, cool. I have two different businesses. I've been in the, call it, investments and finance business for more than 3 decades. And about 20 years of that time was wealth advisory in both client-facing roles and then kind of strategy and business building roles. And then about a third of my time, or 12, 13 years, has been focused on founder exits. And some of that was as a buyer. I did 14 deals as a buyer, as a partner at a private equity firm. And at a certain point, that didn't feel quite right to me. And I found that I was much more connected to founders and entrepreneurs and their story and getting them to better outcomes. And so I formed Candor Advisors 5 years ago, and we've been involved in $1 billion worth of transactions in that period of time. We work as both investment bankers on, kind of narrow and select processes where we only work with selling founders. We will not represent a private equity firm. We don't do any work for buyers, only selling founders. And then we also are consultants to companies that they've built great businesses, but they want to make sure that they're really valuable businesses too. And so we help them to, lean into the things that are going to get them a higher multiple at sale. And maybe more importantly, mitigate the things that might harm them when they go to market. So yeah, we've got a lot of stuff going on. There's plenty of turbulence out in the marketplace to talk about, but there's also plenty of great stuff to talk about. So let's dig in, man.
Okay, cool. And then also, just so everybody knows, Kirk actually helped me in my deal in 2021. We become good friends. He's down in San Diego area. I'm in Orange County, so we're pretty close. But for any businesses, I'm sure, Kirk, you work with people everywhere. But if anyone's exiting in the San Diego, Orange County area, he's pretty close by. So that's where Kirk is. And so Kirk, what are you seeing in the market right now? I mean, and then also if you can kind of focus on the product side of things for the listeners.
Yeah, absolutely. So look, there was most of 2024, there was deal activity happening, but I would call it like the marketplace had woken up from its Goldilocks period where, the buyers were poking around at things, but everything was, just not quite right, or they'd only buy it at a price. And a lot, people got to exits in 2024, but there was a lot of uncertainty and a lot of pickiness in the market. And then after the election, what happened is, regardless of how you felt about whether your side won or lost, the uncertainty was gone. And what happened with the merger and acquisition or exit market was that all of a sudden there were no more question marks anymore. And, there was the tailwind of the idea that the new administration would be regulation light and pretty permissive on, kind of deal structure and capital flows. And so things got really hot, like everywhere. The markets all of a sudden came back alive. We signed 7 NDAs in the first 2 or 3 days of the year. I mean, it was just that hot, looking at companies. And, things were rushing forward. I know lots and lots of other investment banks in our network were working on a ton of deals. And then the tariff stuff got announced. And the markets in general came to a screeching halt. And what's happened now is that, it's kind of barbell. There are all the deals that would be impacted by tariffs or supply chain are either what the M&A guys call pencils down, meaning they've just stopped working on them, they're paused, nothing's happening, or in some cases circling the drain because the buyer was eager, maybe it was strategic, and now that everything in their kind of purview is going to be impacted by something that they can't yet figure out. They've just stopped all effort there. When I call it a barbell, it's because the other side of things, professional services, we're talking about accounting firms, engineering services firms, all kinds of firms that are kind of CapEx light or not impacted by tariffs, not impacted by supply chain. And a lot of what I would call traditional services businesses too. I think of the private equity guys call them field services. We think of them as just like trucks and clipboards businesses where, landscaping, pool services, restoration, kind of anything where, there's a lot of cash flow and have been kind of traditional lifestyle businesses. But now the private equity people are thinking about scaling those, and they also don't have exposure here. Private equity is thirsty for those deals. So there's a ton of activity there and virtually none on the other side. There's a few people trying to get creative over here, but very little activity here.
Okay. And we want to stay on that side, but on the service side, some of those businesses, a lot of them are not that big, right? I mean, maybe the pool businesses are doing $1 million to a couple million EBITDA. Traditionally, private equity wants, 5 million EBITDA before they dig in. Are they going lower? Are they going into the $2 and $3 million businesses, or how are they buying those?
Yeah, great question. Because that's exactly right. You framed it exactly the right way. Historically, they had no interest in those businesses because they didn't think they could get scale in those businesses. They didn't think they could put together 6 or 7 landscaping businesses and achieve any benefits of scale. Now all of a sudden they do, and private equity investors move like sheep. I mean, they're very, very smart people, but their crowd behavior isn't smart. So it's like 2 or 3 people do a few good deals in landscaping, and now all of a sudden everybody wants to do landscaping deals. Same thing happened with wealth management over the last 10 years. Nobody wanted to buy wealth management firms. Now everybody's thirsty for
that. Is interesting.
And the other piece you pointed to is not only have they come down, we know of a multi-billion-dollar buyout fund up in San Francisco that has 150 employees, only 9 of whom are principals on kind of the investment side. Everybody else is deal development and due diligence. They have come down to where they did 83 transactions in 2023. I bet they did more than 100 in 2024. They'll come down to $1 million. So the private equity firms have gotten to the point where in some cases, they're either creating the platform company and then going out and finding the add-ons, or they buy a company, turn it into the platform company, and aggressively start adding on stuff. So, it's what I would call kind of hypothesis investing, but not hypothesis like I'm going to invest in AI because I'm going to replace digital assistants and then that's going to make this work. It's more like, I think if I can get this to 25 million of EBITDA, I can sell it for 12 times. Therefore, I'm going to go look for as many opportunities, whether they're 1 million or 7 million of EBITDA, to get them all consolidated together to then sell them to the next guy.
Yeah. And for those listening, if you're not familiar with what, the key here is that, back in the day, even just a couple of years ago, if you wanted to sell to private equity, you sort of wanted to have about 5 million EBITDA net profit to at least, right? And more. And that would allow you a better multiple. And if you were less than that, you're getting a smaller multiple. And if you're 10 or 15 million, you're getting even a bigger multiple. And the point here is that, I mean, maybe there just isn't, there's so much private equity and probably not enough businesses, 5, 10, 15 million, that they're coming down into the, $1, $2, $3 million companies. So that's pretty interesting trend, one that people should know about. And then as far as products, so physical products, consumer goods, but more than just consumer goods. Could even be manufactured here, could be imported. I guess if it's manufactured here, you're probably safer. And if it's imported, I mean, let's just talk about this. How can one even make an investment if, say, someone's bringing their stuff out of China? We don't even know where these tariffs are going to land. So
Right.
are any deals happening, or is it literally just, I mean, what's a private equity thinking, and what should a CEO be doing?
So it's a fantastic question. And there's what I know to be true because of the deal flow that I'm involved in.
Yeah.
There's what I'm pretty sure is true because we have a big network of other investment bankers that we regularly talk to. And, a lot of private equity firms that regularly update us on what they're doing. And so we assume that they're both telling us the truth. And then there's what we're reading in the headlines. So what we're reading in the headlines is that deal activity has kind of come to a screeching halt, or kind of the brakes have been put on. What we're seeing, in terms of what we're doing, and we're working on more services stuff, but we talk to lots of investment bankers who are working on product-oriented deals, and we have worked on product deals, yours included in the past. What we're seeing is that if something was 2/3 to 3/4 of the way done before tariffs got announced, and you got a willing buyer and seller, then the groups are trying to figure out how to change the deal structure so that the buyer isn't penalized if tariffs become permanent, and the seller is able to exit, but also has to maintain some of the risk of the business in case tariffs become permanent. So nobody's going to pay you for a forward, kind of looking 12 months with an assumption about tariffs, but they might modify a structure that will allow you to take enough cash to feel like you did sell the majority of the business, but also that you and your financial partner, in this case, are truly partners. If your desire to exit, is I want them to take all the risk of continuing to run my business and I want to ride off in the sunset, on the product side, that transaction is not happening. But if there's a strong desire to exit and both parties were pretty aligned anyway, there's a way to kind of equilibrate the structure to make that work.
Yeah. And that, you know what, those words, because, you're a deal guy and a lot of CEOs don't understand that or think like that. I mean, you really have to find alignment. You have to share that risk, because a lot of times, we just want to sell the bit. Well, why can't we sell it? And PE's obstacle is like, because, we need to mitigate risk. Okay. So that makes sense, because how do you look at a business? Now, I think the average tariff is, it's probably not for every product, but for a lot of consumer, it's going to be 30% plus the 25 that was already there. So, it's around 55, give or take a few points on the category. What type of multiples are you seeing in, say, different product businesses? Could be D2C, could be Amazon, wholesale businesses. And I know it's going to vary with size as well. And I'll just say that, back in 2020, 21, maybe even 22, interest rates were low. So that helped, right? That give like an extra turn. Are we like a turn lower, or where are we now when it comes to multiples?
Yeah, so a lot of it has to do with, first, going back for a second on one of the things you were saying. I want to double click on the idea that the buyer of your business, if you're a builder, an entrepreneur, is a full-time predator, and you are part-time prey. And I don't mean they're bad people. I just mean that their junior analysts have more M&A experience than you'll have in your entire lifetime if you start and sell 3 companies. They've worked on more deals last month than you'll work on in your life, and it's all they do. So they're really, really good at coming up with financial models to make any deal work. Understand they have no operating experience, and so they don't actually know how to run a business, but they sure know how to tell you how to run a business, right? And so what they're trying to do when they buy a company is use as little equity as possible, not too much expensive debt, and get the founder to keep his or her kind of wealth build opportunity somewhat tied to the business, not only transitioning well, but achieving some objectives in the future, right? So the way to think about it from our standpoint is risk transfer. The private equity firm wants as much of the risk transfer to remain with the seller as possible. They want to take as little as possible. You, on the other hand, as a seller, had no idea that there would be anything other than 100% risk transfer to your buyer.
That's right. That's right. Yeah.
So talk about a disconnect. So that's one area where an M&A lawyer, a good transaction advisor, can draw the distinction.
And before we go forward, just, for those, because not everybody understands all of this. So if you're selling a $30 million business, it may be as simple as that you have to carry 20% of the deal forward if you're the seller. And are you saying that's even gone up? Is it more than 20% now, or?
Yeah, on a product business, yeah, because what they, on services business, no. But, the way I would say it is that the private equity firms need to put the capital to work. They've raised it sometime in the last 4 years. They usually get a 2 to 3 year window that's called an investment period, and then they have to move into a harvest period. Or said another way, they get 2 to 3 years to invest all the money, and then they get 3 to 7 years to sell everything for a lot of money to make a big multiple on that invested capital. So they need to put the money to work because they didn't have a big year last year in getting a lot of deals done. And if they raised it 3 years ago, that means they have to get it to work this year, even if it means they have to overpay. So they'll overpay. They might pay, 6 or 7 times for a business that, might otherwise sell for 4 or 5 times EBITDA, but they'll structure it in such a way that if you did what, we call internally, I haven't heard a lot of other people use this, but we call structure adjusted valuation, sort of like thinking about the cash flows that you get from the investment. If they're structuring it in such a way that you get very little cash up front and you're asked to retain a bunch of the equity until they sell it in the future, or worse yet, they expect you to wait to get a payment contingent on some future performance you can't control, like an earnout. They're putting more structure in deals because they're essentially, every time that the market kind of ebbs and flows, the private equity people start using the same coded language, which is sellers need to get realistic.
Yeah.
Buyers seem to never have to get realistic, but the people that actually created the businesses need to get realistic, which is another way of them saying, hey, maybe I'll pay you 6 times for this business, but really, when you look at the cash flows coming through, it's going to look like more like 3.5 or 4 times. It might be 6 times 7 years from now if everything works out the way we think it will. So they're just using a lot more structure. And you kind of can't blame them from the standpoint they have a fiduciary responsibility to protect their limited partners, their investors, from making bad investments. On the other hand, we only represent selling founders, and we would say that sounds like a you problem, not an us problem, because Luke spent 30 years building his business. You're making him sell it at a multiple of the last 12 months worth of EBITDA, and you're further asking him to guarantee it's going to get better next year, even though he's not going to continue running it. To our mind, that says Luke deserves to transfer as much risk as possible. So there's the kind of the tension in the deal right there.
And then for those listening, just on a quick level, what are the, most common points of structure? Is it like the rollover? Is it still just like a working cap thing? But you do a lot of service businesses, so they don't have a lot of that. So just, what are you seeing as far as structure that even and how can that be negotiated?
Yes. So the way we think of it, Luke, is that, there's cash and structure. Structure is everything that's not cash. You can think of the whole thing as structure, but, so there's the cash component, the cash at closing. The part that is certain that you get wired to you. You owe taxes on it right now, but you get cash at closing. So that's one component of the deal. The 3 most common other components to the deal are taking back a seller note. Like they buy 70% of the business in cash and they ask you to carry back 30% of the business. They say they'll pay you 9% a year until they sell the business, which means you could theoretically foreclose on your business, but chances are they're putting in bank financing that's up above you. But like a seller note where the buyer is using your company to pay you interest payments until they sell the business, that's another, a common structure piece. Earnout. like we'll pay you 70% in cash, and 30% of it will be based upon how you do in the next year. Do you maintain EBITDA? Do you grow EBITDA? The tricky thing about that piece of structure is it's a contingent payment in the future, and you no longer control the expenses of the business because you sold them the majority stake in the business. And so now they can add 14 new salespeople, wipe out your EBITDA. You're not going to get your earnout, and you'll never be able to sue them because they'll say they were trying to grow the business. So the earnout is our least favorite. And if you're working with a really heads up private equity firm, it's their least favorite too. Because I tell you, and I recently validated this with a very experienced M&A attorney. He told me in 20 some years of doing deals, he's seen maybe 20% of earnout payments ever get made, right? They just don't happen very often. The last piece you mentioned is retained or rolled equity. And that makes a lot of sense if you're going to go along with the business and you're selling into something that's going to be built up to be bigger. And so maybe you benefit, maybe they pay you 8 times for your business. And once it gets bigger, even though you own a smaller chunk of it, maybe they sell it for 12 times. So you're selling at a 50% higher multiple. So maybe you get a second bite of the apple. The thing you got to be careful about there is, what is the track record of the firm that's buying your firm have, right? If you sell your firm to a search fund that has no track record, or a family office that doesn't maintain a track record, or a first-time buyer, or an independent sponsor, and they have no track record, then you're essentially investing a piece of your wealth with somebody who has no reason to expect you to, have a piece of your wealth to manage, right? That's that rolled equity piece. So it's going to be cash, seller note, earnout, rolled equity. Those are the components.
Yeah. And those are for typically, just for those listening, there's going to be platforms, which is, that's where they're buying your company, and you probably have these options right here. And then there'll be add-ons, which are smaller companies. Maybe you're doing $1 million or $2 million or even 500,000 of profit of EBITDA, and you're being bought by one of their platforms. So when smaller companies, if they're selling at, let's just say it's $1 million company, and the platform's doing, say, 5 million, is that $1 million company still have the same limitations? Are they being paid out cash? I know they're usually a lower multiple, but do they have the same thing where they've got a roll, or does it just depend on the deal?
Yeah, so it's likely that the platform's going to get the biggest or highest percentage of cash, and have the most to do with whether the rolled equity from the add-ons ever works out or not, because chances are the platform ends up running the whole apparatus. The smaller companies, the tuck-ins or add-ons, are more vulnerable. So they're going to get a lower multiple, and they're probably going to get asked to roll more equity. And that might be a great way for them to get to a second bite of the apple or a bigger outcome. The challenge is that often those smaller companies are growing faster than the platform. And so to some extent, they're getting a lower multiple, and they're giving up on, higher growth, right? So what ends up happening is they definitely help the platform to get bigger and potentially have that multiple expansion, that bought it at 8, sell it at 12. But they're generally, what we think of it in terms of, are you a terms maker or a terms taker? And the add-ons are always terms takers. The platform might be a little bit of a terms maker and a terms taker, depending on the give and take. But the platform, the add-on to the platform, is always a terms taker.
And what do you see now as far as the spread of strategics versus private equity? So again, for the listener, strategic would just be another business buying you, versus private equity. And my understanding is it used to be more strategic years ago, and now there's so much money in private equity that they're sort of dominating the purchases.
Yeah, so there's at least $2 trillion available with financial buyers, whether it be private credit or private equity. And so they definitely set the market, because, to your point, Luke, the businesses that are in your businesses, the strategic, they're acquiring your customer list, or they're acquiring your unique product or service set, or they're acquiring your geography, right? And they're not in the business of investing money on behalf of investors, even those that are public companies. That's not their business. They're in your business. They're just like a big competitor or just adjacent to you, right?
Yep.
The private equity firms, on the other hand, because they have so much capital, they can, with the right transaction advisor, they can be used to push the strategics to pay more for your business. Strategic doesn't have as high a cost of capital as a private equity firm, right? They probably got it on their balance sheet. They don't have to borrow anything. Or they can borrow it from their bank at a much lower rate than, say, a private equity firm can go out to a private credit firm and borrow money. And so I would say strategics are definitely in the marketplace, especially for product companies, because, new concepts or unique add-ons that take advantage of a big product company's distribution network, and, kind of their hub, their selling general administrative expenses are already kind of locked in, so they can eliminate some of the costs of the smaller companies they add on and just get the product, services, and productive people. Right. So strategics are still in a better position to take advantage of things, but the private equity firms have so much capital that they oftentimes win just because they can overpay. And oftentimes I wouldn't say they go about trying to mislead the sellers, but what ends up happening is, a strategic who's going to buy your business for 80% in cash and 20% rolled equity, you have an idea of what your rolled equity is going to turn into, especially if it's a public company. But if a private equity firm says they're going to give you 60% cash, 20% rolled equity, and 20% in an earnout, they might be telling you that the overall value of their deal is a higher multiple than the strategic. But I would tell you that on a risk-adjusted basis, the strategic deal is the better deal. Even if the multiple on the private equity firm is higher, because it's all about how much you get. How much you get right now. And if an earnout is just passage of time, you're going to hit it, that's not that risky. On the other hand, if when the private equity firm was talking to you about buying your firm and they said, how do you think you're going to do next year? I mean, you don't have to do some big forecast or spreadsheet or whatever else, but how do you think you're going to do next year? Well, if you say, heck, I don't know, we might be flat, then you're afraid they're not going to buy you. And if you say, I don't know, I think we'll add a couple of points of growth, they're not going to be that excited. So you think 20% is too much to tell them. You think 10% is not enough. So you tell them 15%, and then they structure your earnout at 15%.
Yeah, I was going to say, be careful, because then they'll drag out due diligence, and you got to hit those numbers. Otherwise,
That's right. That is
exactly
right. That is exactly right. They're not setting a trap on purpose. Just by definition, it becomes a trap. So you whiff on hitting the 15%. You don't get the earnout payment. You hate them, and you still have to work for them. And so it ends up being the worst thing that can possibly happen for an entrepreneur. He sold for less than he thought he was going to, and now he's got a boss. 20, 30 years, hasn't had a boss, right? Now he's got a boss, and worse yet, it's probably somebody that doesn't speak his language operationally. Right. So, it's the structure you got to be careful of. And if you're in a product company right now, unless you're selling to, a really, really big strategic who knows that, life ebbs and flows and they're going to take the tariff risk, I think it's better to wait it out. I think it's better to just say this cannot be the best possible set of circumstances to be selling a company that's sourcing, some or all of its products from a place where tariffs are really, really high.
Okay. So, and, hopefully we have some certainty on tariffs, hopefully we'll see what happens in the next couple months. I mean, we just need certainty, right? Then everybody can know, can they stay in China? Do they need to move out? But I mean, we need some certainty there. So, talk about what makes a physical product business attractive to private equity. Now, most people don't have a choice. I mean, if you have a product business, that's what you got. So that's what you're going to eventually sell. So what are the couple things you should really be focusing on besides just getting your EBIT up?
Yeah. So private equity firms are easy to understand. They want everything to operate like a software business. I don't care if it's a dry cleaner or, a functional beverage or a software company. They want it to operate like a software company. So they want monthly recurring revenue, and they want as much net recurring revenue as possible. So if you think about a product company, if you create a flywheel, the way Scott Galloway talks about, where you've got like, you may be selling products, but you're also selling things, some sort of regular consumption of the product, the more you have recurring revenue, the higher multiple you can expect. You may not sell at a multiple of your revenue, but if you have recurring revenue or highly reoccurring revenue or highly reoccurring customers, then you're going to sell better into private equity. You're going to get a higher multiple. And if you document with that with a few years, and you can show people how that has worked, and you can also show people how you're expanding into adjacent geography or adjacent products or services, or you're adding a service component to your product sale so that there is some recurring revenue, then you can expect to sell at a higher multiple, and you can expect them to be just, because think about it, they're spreadsheet jockeys, right? So it's easy enough to put a formula in a spreadsheet to show that the trees all grow to the sky if you can document for them that you've been doing that along the way. And they're going to believe that you have hit the limits of your capacity to manage this business because you're an entrepreneur and you didn't go to the business schools they went to, and you don't have their backgrounds. And so they're certain they can run your business better than you. You just need to show them the trajectory you put it on. So first it's the recurring revenue, then it's the opportunity for adjacency. And then it's showing them that there's blue ocean you haven't yet exploited, right?
So with that in mind, let's brainstorm, or tell me what should founders do if they're a year or two away? Like, there's obviously a few things to get under, but is it even is it a crazy idea to say, wow, you should probably launch some new products so that you can like, when you're in due diligence, you don't want to fail your forecast in due diligence. So you sort of want to build momentum going into it, right? So how should founders think about that? Because it's easy to say, well, just make sure you're growing, but I mean, you have to do something special unless your business is on that great trajectory. What do you do with people, and what's worked?
Yeah, this is a great question. I wish there were more, I don't think that there are enough resources that make themselves available or get founders' attention enough to be asking this question, because it is in that, if you have an 8-figure deal, you're going to leave 7 figures on the table by letting private equity do these things in the first year or two they own your business. If you have a 9-figure deal, you're going to leave 8 figures on the table by not doing these things. This is the low-hanging fruit that private equity exploits. They come into a business that doesn't have professionalized financials, right? And they professionalize them. They get them more systematic. They start managing the KPIs, and they start tracking margins. So if you're not doing that, do that, right? And if you're working with a decent accounting firm, have them start to recast your financials so that you've got a rolling sense of what your EBITDA is. And while you're at it, you touched on this before, what's your working capital? Whether it's your monthly or your quarterly working capital, because most transactions, you never see a lawsuit over a non-disclosure agreement or a non-circumvention agreement, but you will frequently see problems after a deal based on a misunderstanding of how much cash was going to be left on the balance sheet for the buyers to take advantage of, and who was going to do the assessment and how it was going to get worked out if the working capital peg or the working capital formula wasn't well understood on both sides. You need to professionalize the financials first. Then, if you're selling in the next 1 or 2 years, no big swings. Don't do some, massive computer system that you think you're going to get paid for, that you think is going to impress the buyer. Let the buyer see that you're right at the position where that is a natural thing for them to do. Let them do that. Don't, I'm not saying don't keep going on making your ERP system better. Don't keep going on refining the things that make your business more professional, but don't take any big swings. And to your point, hey, look, you might think that Arizona, Oregon, and Nevada are all ripe growth markets for what you do, but you haven't got any kind of early traction in those markets. If you're going to do that, better to test the hypothesis small and early if it's working, keep leaning into it. If it doesn't work, that'll be great to put into the confidential information memorandum, the company presentation, that, we think there are some other markets outside of ours. We've tested a few. We know a few that don't work, right? Here's the other ones that we think have the right demographics to grow into. Because if you make a big hypothesis that bets a lot of the company's business and redirects a lot of its profitability into longer term capital expenditures, and they don't work out, you just end up having to wait to go back to market later, because the private equity firm needs to be guided to something that's working well, and is you sort of leaving them a trail of breadcrumbs.
Yeah, I mean, and you've worked with more companies than me, but from what I've seen, very few companies, well, not probably less than the majority under 50 million, and way less companies doing under 20 million have the financials that a PE expects. So that was a good place where you started, was on the financials. Because I mean, there's, because first of all, you leave a lot on the table if you don't have your ad backs incorrectly, right? And so there's all these ad backs, and you're going to do a Q of E, and so I think and a lot of diligence can fall apart if those financials are not done right. And then once the deal's done, you're going to have to kind of step it up in that area. Why don't we finish with due diligence, which is always everybody's nightmare. But what are the biggest surprises you've seen, or deal killers, in due diligence and with companies you've worked with?
Yeah, so I'll say that, due diligence, which, for the listeners who haven't been through a transaction, this is, you've made some assertions to the company that's buying you about how your business runs and what it produces and how it's organized. And the due diligence process, where they have exclusivity to be looking at your company, you can't keep shopping it around, is all around validating what you've told them and them asking a whole bunch more questions. So it would not be uncommon to get somewhere between 100 and 250 requests for information in due diligence. It is invasive and it's accusatory. The only positive thing is there's almost a literal pot of gold at the end of the rainbow. When you win in due diligence, you get a big wire transfer, right? Yep. But it's going to go on and on and on and on. And I can tell you that while private equity firms are better at buying companies than strategic buyers are as a class, because they do it more often, they never stop asking questions. So you'll be getting questions right until the wire transfer happens. Strategics know when they're done asking questions, and they're usually better at vetting the information they truly need. But they usually use really expensive law firms and accounting firms and outside consultants to do the work. And those people bill hourly. So they're going to make sure that they are super thorough. And so due diligence is just going to be a beast no matter what. Where we see people, the big surprises are usually, because there will always be one or two hiccups in due diligence. We've had, deals where there are 3 or 4. They're usually things that the founder, who's never been through a transaction, didn't think was relevant. And so while they might read the question of, are you aware of any outstanding legal issues? You say, nope, nobody's suing me, right? And you're forgetting about the email that got forwarded to you from somebody, who heard from a disgruntled ex-employee who wasn't even like highly paid, who's pissed, right? That might turn into a legal issue. That is sort of like, I'm not saying that it's fraud if you don't talk about that, but let me tell you, your buyer will view that as you hiding the football. If you didn't disclose to them, hey, look, nobody has told us that there's a lawsuit coming, but we got an ex-employee, here's the thing. Or let's say you settled something 12 years ago. It's long since dead. You don't even worry. It don't give it any thought. This is all in legal due diligence, but you don't have proof that it's settled, either because you've lost it or it's so long ago. They're going to want that. And then there's things that get in the way. Like, let's say that you're doing some really thoughtful estate planning, and you're doing something like putting money into a trust that gets it in the hands of your kids and future grandkids. But the shares haven't all been transferred, between the entities. And you're in the process of closing, and you think, look, I own 100% of the business. I'm making a few moves from an estate planning standpoint. It's a simple business. What do you guys need to know? Let me tell you, that could actually delay closing that could actually create significant problems. So the best thing to do is almost like, since due diligence is invasive and accusatory, is disclose to your investment banker or your M&A lawyer who's going to be addressing those requests for due diligence like you would disclose to a criminal defense attorney what you've done. Put them in a position to be able to respond to these things, because they will have seen everything before. And look, then there are other things that I mean, we've been involved in deals where our primary point of contact, public company buying one of my clients' companies, we're 2 days away from closing. We have a difficult conversation with the buyer's counsel, and they go dark on us for 12 hours at a critical point in time. And the guy reaches out to me a different guy reaches out the next day and says that the guy that I had the last conversation with had a heart attack. Right?
Oh, geez, yeah.
We've had that happen. You can't anticipate that. So you name it, we've probably seen it or heard of it in our network. But the key thing is prepping for due diligence by, getting guidance from either your M&A attorney or your investment banker to start working on that stuff as soon as possible, because it's going to be just a ton of information. You just slog through it.
Yeah. Yeah. And for me, and a lot of people are probably, a lot of founders are probably like me, we don't love the paperwork. So hopefully if you have a CFO or you've got someone in finance who can run all of that for you, boy, it makes life easier. So if you have to do it yourself and you're running the business, it's brutal. So, and there are a lot of companies that are, like in that on this small business, but say, they don't have that full management staff yet, right? Let's say they're 25 people or something, right? And they're getting bought. They may not have that full management team. So it's really good to think ahead of time. Who can you share the deal with, and who can you bring in and put the workload on them? Is a good way to make life a lot easier during that deal. Kirk, this has been awesome. Maybe we should do these, every quarter or something, but we can get more specific on the next one. But thanks for coming on. Share where people can find you. I know your main site, Candor. Is it Candor Advisors? Is it .com?
Yeah. So it's CANDOR-ADVISORS.com. And then we've also got a business that, helps people through free webinars and some other resources to learn how they need to prepare. It's called ebitdauniversity.com, EBITDA university.com. And I will, double click on one thing you just said, because you won't toot your own horn, but part of the reason you got such a fantastic outcome and had a smoother time in a long due diligence process was you hired 2 rock stars, right? But, a year or 2 before you went to market.
Yep.
Because as the founder and CEO, if you're trying to do it all on your own, you don't have any internal resources, you've just got a less good chance of having a great outcome. You've got to have some superstars around you to carry on. So bravo.
Exactly. Well, thanks, Kirk. It's been awesome. And I'm sure we'll talk again soon.
Sounds great. Thanks, Luke.
All right, buddy.